Trading for a living, some facts. Whether you are new to the stock markets or been there for some time, if you are watching this video, it means you are looking for more and more information and at the same time learning. In this ever-changing world, it is important for all of us to keep changing with time and the changes those are taking place, but at the same time the basics of technical analysis remains the same. I would suggest you to listen through the entire video and I am sure you will be getting some good information. I would also ask you to subscribe to the channel and press the bell icon to receive notifications so that whenever there is a new video, you get notified. I am beginning with basics in the first few videos, but down the line, I will be giving great information on technical analysis. These information are from the masters, but here I will be putting them in one place with some modifications as the changes demand, which will make them even more helpful. If you are experienced trader, then you already know the percentage of losers and winners, but if you are new, remember that only 2% of the traders make money and the rest 98% of the traders lose money as a trader in the stock markets. When I say stock market, I am actually referring to equity markets, commodity markets, forex or the crypto too. The 98% of the traders who lose money are actually the ones who act as an supplier of profits to the 2% winners. This is the reason that if you are on the right side, which is the 2%, you can actually make a lot of money. There is no second way to match the amount of money which one can earn being a trader in the stock markets. If you have to stay in the winner's bracket, then you have to compete against the masses and beat them in the game. This means you need to think and act differently than the masses. Always remember that emotions can play a spoil sport as to how you trade. If you can control your emotions and trade rationally, you will definitely make profits, but before that you need to learn how to trade. We can never profit just based on our thoughts. Each and every decision must have an explanation as to why. An experienced trader is always calm and keeps her cool. They always know what they want to do irrespective of the fact whether the market is going up, down or is choppy. When not sure of the market moves, they stay on the sidelines and watch till they get their trade set up. There will be times when you make profits and there will also be times when you will make losses. If you feel excitement when profiting and upset when you make a loss, then you should know that your emotions are taking over you. You should never be emotionally attached irrespective of whether you make profits or loss. You need to treat it as your business. If you get emotionally attached, that is when the greed and fear comes into play. Even the best of traders make loss, so it is a part of the business. Many come into trader with a goal to become rich overnight, but we must always keep in mind that there are millions of more knowledgeable traders already in the market. Trading is not gambling, which many enjoy due to the highs they get in these kind of activities. Technical analysts use price and volume data and not the fundamental factors for deciding what they buy or sell and when they buy or sell. Fundamental analysis has limitations while technical analysis is universal. By saying universal, I mean to say that once you understand the principles of charting, you can apply them on a wide range of trading vehicles, be it stocks, currency, bonds, commodities, cryptos, etc. As the trading vehicles increases, the use of technical analysis increases, and that is why it is becoming more and more popular. As long as you have the data on high, low, opening, and closing prices, along with that on volume and open interest, you can make intelligent judgments about the balance of power between bulls and bears in any market. Then you can trade in the direction of the dominant market group. It's relatively easy to recognize patterns in the middle of a chart, but good trading signals are much harder to identify near the right edge. That's where you'll have to make your trading decisions, amid the uncertainty, noise, and tension of the markets. It is easier after the charts are formed, but the main decision an technical analyst has to make is, based on the past and current charts, you have to determine the future moves. Computers, software and easy access to data have made it much easier to have your charts ready. Beginners watch only prices. It's easy to become hypnotized by stocks moving up and down. Experienced analysts gain a much deeper understanding of the markets by including volume in their analysis. In addition, price changes need to be linked to the length of time it took for them to occur. All trading decisions have to be made by analyzing more than one time frame. Markets consist of huge crowds of traders whose buying and selling create waves of mass optimism and pessimism. The resulting price trends lure in bystanders, and their buying and selling reinforces those trends, driving them to unsustainable extremes. Fundamental economic factors may rule the markets in the long run, but mass psychology determines intermediate and short-term trends. Several indicators take the pulse of the market crowd in stocks and futures. The indicators that analyze the stock market as a whole are especially useful for trading stock index futures and options. Since the broad market trends influence most stocks, those signals also help stock traders. General market indicators are especially important to those who trade in the United States, where several advisory services track them. Overseas traders could profit from developing similar tools in their own countries. A trading system provides a decision-making tree for setting entries, targets, and stops. It is a useful instrument but not a magic device that can be fine-tuned on old data and then put on automatic for effortlessly pulling profits out of the markets. You develop a trading system in the quiet of your office, when the noise of the markets has quieted down. A carefully crafted system becomes your island of stability and intelligence in the stormy environment of the market. A trusted system will help you maintain control at a time when the tide of mass emotion sweeps people off their feet. Some professionals say, "I don't trade stocks, futures, or options, I trade money in my account." They focus on system design and risk management, while what they trade are just vehicles in which their money goes for a ride, hopefully in the right direction. You have an enormous choice of trading vehicles. Before you focus on a single class or even a smaller group within that class, it pays to know what other instruments are available to you. Even a brilliant system will not guarantee winning in every trade. This is why every system must include risk management rules. Many creators of promising trading systems keep losing money because of poor or absent risk control. Each and every system has its drawdown periods. That's when risk management means the difference between life and death. No system will do you any good if you don't manage risk. Professionals spend much of their time calculating how much money to risk on any given trade and how to vary trade size, depending on market conditions and account equity. Risk management is essential for your survival and success. Once in a room where a world-famous technical analyst lectured about gold. He projected his charts on a screen and pointed out trends and potential reversals. A trader in the audience raised his hand, "So, at the right edge, would you buy or sell?" The great expert pondered the screen and uttered, "Well, I'm sure that in 2 to 3 weeks, the answer to that will be very clear." The trader stared at him incomprehensibly. In trading, you don't have the luxury of waiting for a couple of weeks for an answer. You need to decide now, today, what you'll do at the right edge of the chart: buy, sell, or stand aside. Standing aside, by the way, is a legitimate choice. If you decide to trade, you need to choose where to enter, set targets, and place stops. Traders use a wide variety of methods to accomplish these tasks. Keeping good records helps you identify past mistakes and stop repeating them. Good records make clear what steps brought you profits, so that you can repeat them going forward. Good record-keeping ties together psychology, market analysis, and risk management. It is the best tool for developing and maintaining discipline. To improve your performance, you must learn from your experiences, which is what good record-keeping allows you to do. It is the most important skill for your growth as a trader. Thank you. Soon I will come with more videos to show exactly how you can develop these skills, step by step.